And now I'd like to introduce our presenter, Heather Jackson-Vazzari. Heather is the owner and president of JF Business Solutions. It's a company that works to empower small businesses for sustainable growth through tailored accounting and finance solutions. She is a certified management accountant and has a certification for QuickBooks also. She did her undergraduate work at the University of Buffalo and her graduate work at Canisius University. Heather is a SCORE volunteer and a frequent presenter on business financial matters. Heather, I'd like to thank you for taking the time to present to us tonight. At this point, the microphone and the controls are yours.
Thank you, Ted, and welcome everyone. Today's webinar is Cash Flow Management for Small Businesses. And with that, we will look at our learning objectives. So we're going to take a look at the cash flow statement and break that down as a review for anyone who's not familiar with it. We're going to talk about cash versus profit and what the difference between the two are. We'll take a look at the operating cash flow cycle, what that is, how you can manage it, managing your cash and debts, and then also take a quick look at some cash management tools that you can use for your business. So with that, we will start with a review and breakdown of the cash flow statement. So just a quick overview. A good starting point with managing your cash flows is understanding your cash flow statement. So this tells you where your cash is going and where it's coming from. And we'll start by walking through the cash flow statement and its components. So you can see here a quick example of a cash flow statement. It starts with your beginning cash balance, walks through the different pieces of operating cash flows, and we'll take a look at what each of these mean in the next slide. But we look at operating cash flows, investing cash flows, financing cash flows. We've got a change in cash, and then your ending cash balance. So any of these numbers here that are positive, those are cash coming in. Any numbers that are negative are cash going out. And so that's what the cash flow statement tells us. And this is one of the three key financial reports that you should be looking at on a regular basis for your business, along with the income statement and the balance sheet. So digging into the components of the cash flow statement. As we mentioned, the first section is operating cash flows. And these are cash flows that are generated from the day-to-day operations of the business, hence the name operating cash flows. These are the key pieces of key items that you're going to be able to control when managing your cash flows. And we'll talk about that a bit more later on. But these are items such as changes in your accounts receivable, your accounts payable, inventory, net income, and things like that. So that's going to be the first section. The second section on that cash flow statement was investing cash flows. These are cash flows that are related to investments, and most likely these are related to what you'll see as purchasing or selling fixed assets. You might also hear fixed assets are the same as capital expenditures or property, plant, and equipment. They can be called different things depending on what system you're using or who's preparing your financials, but those are all the same. And those would be investing cash flows because you're investing in your business. Last is financing cash flows, and these are cash flows that are related to funding the business. So these are typically related to cash in or out for debts. So if you take a loan, that will be cash coming in when you first get the loan and the cash first comes into your bank account. If you're paying on that loan, that cash will be going out. So you'll see a negative on that cash flow statement for the payments on the debt. It can also be depending on the type of business structure you have. There could also be changes in equity or dividends. If you pay dividends or take owner's draws or things like that. Those would be in the financing cash flows as ways that have funded the business or cash out of the earnings of the business. So those are our three components. And we'll talk a little bit more about how to now read the cash flow statement and where some of the numbers come from. So we'll start with our income statement. So here's an example of an income statement and kind of the top section of our cash flow statement. So a couple of examples of the pieces that come from the income statement. These are the two key pieces, net income. So you'll see that here is the first line typically on the cash flow statement because that's your earnings for the period that you're reporting. So we always start with that. The second line is typically depreciation, and we add depreciation back because depreciation is a non-cash expense, meaning that it's an expense on the income statement, but it doesn't have cash flowing in and out of the business. So we add that back to net income, and the rest is earnings, and the rest are cash plays. Right. So if you have revenue, that would have been cash coming in. If you had cost of goods sold and your other expenses that you paid for services, supplies, any of that, employees, those are all cash movements. Interest or other expenses, those were all cash items. So that's why we start with net income and then add back depreciation as a non-cash expense. So those are typically the first two lines on the cash flow statement. And then we'll look at the next few lines and where those come from. So next is the asset section of the balance sheet. And again, here are a couple of examples, and you can see some of the others, but here's accounts receivable. So on the balance or on the cash flow statement, sorry, because we're managing cash flows, we don't look at the same number on the balance sheet. This is the balance of that at the end of the period, right? So this is the balance in your checking account. That's the cash that you have at the end of the period. This is the amount of accounts receivable that you have open at the end of the month and the customers that owe you money. So these are all balances. What we look at on the cash flow statement, remember, are changes in cash. And so here we're going to look at the change in accounts receivable. So this would be money that you collected during the month, or and netted with invoices that you sent out to customers. And so we always look at the change in these because that would be your cash collected or your cash out. So that's why it's going to show, it could show as a positive or negative depending on if you had more going out or more coming in. So that's how that's going to roll through onto the cash flow statement from the balance sheet. You can see inventory is on here as well. That's going to work the same way. Other long-term assets. This could be capital type things or investments, and those would roll into the change in other assets and liabilities. But these are all going to flow through operating cash flows. We've got fixed assets here. So again, fixed assets are purchases or sales of fixed assets. So this is going to be your balance at the end of the month. And that's where fixed asset purchases or sales are going to be on your cash flow statement. So if you purchase something, you had cash going out. So you're going to have a negative value there. If you sold something, then you would have a positive number there. And it looks like we have a question in the chat. Um, okay. And this question is from Elsa, looks like. Looks like here.
Yeah, so the question, so change in accounts receivable is 757 for the current year. When you're looking at the current year and the prior year for accounts receivable of 467 versus the 1,328, how do you get the 757?
Sure,
The
that's a
math.
good question. So it depends on the period that you're looking at. So this change, the cash flow statement that measures the activity in a period, right? Just like an income statement. So this is the cash that went in and out during that period. And I don't have, just because these are high level statements, I don't have the period on here. Whereas a balance sheet is the balance at the end of that period. So in this example, because you're right, if it was an exact 1-to-1, then you could say this should be the difference. And if it were a month, like month one, if it were January versus February, then the cash flow statement would represent that. But this could be like year to date, it could be the end of, it could be 2 months versus 2 months versus in the prior year, where other things might have happened in between. So that's a good question, because it's not always explicit when you're looking at the cash flow statement versus the balance sheet, because there might be other cash movement depending on the periods that you're looking at in between. Does that make sense?
I think I'm still muted. I don't know.
I can hear you.
Oh, okay. I guess it does. I guess I would say that if I was saying this is, a cash balance at 12/31/2023, then I would take 2023 12/31 and subtract 12/31/22, right? And
Right.
get that answer,
Right.
right?
Yep.
Okay.
Yeah.
But okay. Yep.
Yep.
Mhm.
So you're on the right track.
Yep.
Yeah.
Okay.
You just have to look at what periods you're looking at, and et cetera. So
All right. Okay. Thank you.
you're welcome.
How do I remute myself?
You should be able to mute yourself in the upper, well, depending on where yours is at, you should have a mute on your ribbon somewhere on the far left. So,
Yeah,
all right.
I've removed the permission to
Oh,
use
okay.
her microphone.
Okay. So moving on to another example. This is looking at the liabilities and equity section of the balance sheet, and starting with accounts payable. This is going to show you, here's your change in accounts payable, long-term liabilities, which are typically loans and things like that, and types of debt. And that's going to be change or repayment of debt down in the financing cash flows. So again, operating cash flows, those are all related to the day-to-day operations of the business. And those are going to start with net income or loss. We're going to add back depreciation because it's a non-cash expense. And then we're going to show the change in accounts receivable, change in inventory if you have it, change in accounts payable, and change in other assets and liabilities, depending on what you have on your balance sheet. That's going to give us the total operating cash flows. We then have our fixed asset purchases that we talked about, that are our investing cash flows, and then our financing cash flows. And if we go back real quick, we see here's our cash balance. And this is another indication that the periods, the starting and ending periods are a little bit different, because our beginning cash balance here is 434. Prior year, this snapshot or this balance on the balance sheet is 818. So that's another way to tell you that there's, that there's some other changes or different periods in between, that it's not going to necessarily be the change between this one and this one. But here's our current year balance. And if we go back to our first slide, that was our ending cash balance. So this was the cash movements from one period to the ending period, to the ending cash balance of the current year on our balance sheet. So that was walking us through to here. Okay. So now that we've walked through the cash flow statement, and we've kind of given a little bit of a refresher on the financial statements, I want to differentiate cash versus profit. Because sometimes people use those interchangeably, sometimes they can be confusing. So cash is going to be the actual cash generated by the business and what's shown on your balance sheet at the end of the month, or the end of the period, and your cash flow statement, right? Those are the actual cash flows in and out of the business. Profit is the earnings of the business, and this is typically displayed as net income on the income statement, or the retained earnings on the balance sheet. So profit is the earnings. So profit is on paper. You can have profit, but you can have no cash because money isn't coming in when you need it, right? Because that goes into timing of the cash flows. And we'll talk about that a little bit more in a minute. So profit is what's on what's on your income statement as net income, and what is shown as retained earnings on the balance sheet. So that's on paper. Cash is the physical cash that you have in the bank. And that's, again, the balance on your balance sheet at the end of the period, and the flows in and out on your cash flow statement. So the cash, you can have cash and you can have no profit, because your expenses are higher than your income. So you can have money in the bank, you can have cash in the bank, but you can be unprofitable because you're not managing your expenses and your income the right way. And again, you can have profit on your income statement, but you might not have the cash because you need to manage your operating cash cycle better. So that's the high level difference between cash and profit. And we'll take a quick look at an example. Okay, so here's an example using a reseller of smartphones to keep it simple. So if you're a reseller, typically you're just buying product and then marking it up and reselling it. Right. So on the income statement, you're going to have $500 of income because that's what you're selling it for. And you're going to have $400 in expense because that's the cost to buy them. So your profit is income minus expenses, or $500 minus the $400. So in this case, your profit is $100. On the cash side, you're going to have two pieces. You're going to have cash in from a customer, which is $500. And typically, depending on how your business works, that cash in is going to come in an accounts receivable. If you bill your customers, then that might take a little bit longer to collect the money from them. If you take credit cards or cash, and you have a storefront or something like that, or you're an online retail store, then you might get the cash quicker because you're taking a credit card, or something like that, or cash at a brick and mortar store. So you're going to have cash coming in of $500 and cash going out to the supplier of $400. So that's the difference. Is the profit is what you're making on it, making on your sales, and what is shown on the income statement, your cash, or the actual movements of cash in and out.
Yeah, Heather,
Yes.
Andrew wants to know if this is cash or accrual accounting.
So, I mean, it's really either, because if you have, well, I should say this. So it's still different, okay? Because you still want to understand the difference between profit and cash. And if you have a cash-based business, then yes, it's going to be much more similar than if you're accrual-based, right? Because if you're accrual-based, you're going to have accounts receivable, you're going to have accounts payable, and there's going to be a timing difference. If you're cash-based, then you record the sale when you receive the cash. So that's a good question. There are some other things that can affect that. Um, like if you buy equipment, that works a little bit different. But yes, that's a good question. because the income and the cash are recognized differently for cash and accrual. Okay. So now let's talk about the operating cash flow cycle. And the first example here is typical for a material business. The operating cash flow cycle is the way that cash moves through the business for managing the day-to-day operations. Okay, so these would be the operating cash flows from the cash flow statement, that first section that we were looking at, and these are typically the easiest to manage. And so if we walk through, you have cash in the bank, cash on hand. You need that cash to pay for materials. So depending on what type of, in this case, we're talking about a material business. So we're assuming that you buy materials. So this would be for a retail business or manufacturing business, something of that nature. So you purchase materials. You may have to manufacture the product. You may just hold the product in inventory, but at some point that becomes inventory. And then that sits there until you sell it. When you sell it, it becomes a sale. And then again, depending on the type of business, you may collect the cash right away, or you may have an accounts receivable that you have to wait on. So if you have an accounts receivable, then you have to wait for the customer payment, and then that cash goes into the bank. So each step in this operating cycle is a different step of how the cash can be managed, and we'll talk about that a little bit more. But these are the cash inflows and outflows that we just talked about related to the cash flow statement. If we are looking at a service business, it's a little bit different, right? Because you don't have inventory, you don't have materials that you're buying. But similarly, you have cash on hand in the bank. And in this case, you may have to pay employees or yourself. Then when they perform the service, you have sales that appear on your income statement. And again, you might have an accounts receivable, or you may receive the cash up front if they pay by a credit card or cash. Then you receive the payment and the cash goes into the bank. So these are typical of a service business. So really the big difference again is the material and inventory between the two. And obviously there's some other pieces with expenses and things that are going on, but the main pieces are, buying inventory, selling product, getting an accounts receivable, getting the customer payment, and things like that. Okay, so we will, let's take a look at how we can manage the operating cash flow cycle to maximize your cash. Okay. In general, you want to collect cash from customers as quickly as possible and pay them when you need to. And I know that that's pretty basic. But the faster that you collect cash, the better. Right? The cash gets into your bank account quicker. The slower you spend cash, the better, because the cash stays in your bank account longer. And the reason that you want to do that is because it gives you more opportunity to use the cash efficiently and to build up reserves for emergencies, right? If you have cash going, coming in late because you're collecting late from customers, then you may be spending more upfront to pay for things. And if you're doing that, and that goes back to that cash flow cycle, right, that we just looked at. If you're paying more upfront and you're collecting it slower than you're paying it, then you're putting yourself in a position to potentially be insolvent and have liquidity problems because you're always chasing that. You're trying to collect and you're spending before you're getting it, and that can create a very, very vicious cycle. So that's that you want to make sure that you're collecting quicker than you're spending. and that you have cash in the bank. And we'll talk about cash reserves and stuff like that in a minute. So ways that you can manage that operating cash flow cycle. You want to bill customers immediately for products and services. You want to stay on top of that, right? The longer it takes you to bill customers, the longer it takes them to pay. Set shorter payment terms with customers and stay on top of your collections. If you're a service business, you don't have to give clients, 30 days to pay. You can give 7 or 14 days to pay, or even due upon receipt, or even prepayments. The shorter that you can make those payment terms, the quicker that you get the cash into your bank account and the more control that you have of it. And then absolutely stay on top of collections. If customers are falling behind, make sure that you're staying on top of that, or you have somebody that is. Another option is to offer customers a quicker way to pay. If any of you use QuickBooks, there's a link when you send an invoice. QuickBooks has a link that they can click on and pay right away with a credit card or a wire or ACH transfer. And then you can also offer credit cards. If you have any e-commerce or online presence, you can offer credit cards. You could take a credit card through a third party, geez, I just lost the name of it. But you can take take third party credit cards through one of the processors. Use the QuickBooks link, or take a credit card or cash if you have a storefront. So any way that you can get them to pay quicker is helpful. On the other side, on cash going out, one of the things that you can do is negotiate payment terms with vendors. You want to make sure that you continue paying on time. You want to have, maintain relationships with your vendors and pay on time, but you can negotiate payment terms with vendors, especially if you buy a lot from them. If they're key vendors of yours, you can, negotiate. It doesn't have to be 30 days. You can negotiate 45, 60 days, sometimes even 90-day terms with your vendors. So that's something that you can do to manage that operating cash flow. And again, that's pushing out some of the payment and cash going out of the business. Purchase only what you need and when you need it. If you have inventory, be very careful not to buy too much, and keep the minimum inventory levels. More inventory means more money tied up. So if we go back to our operating cash flow cycle with inventory, when that inventory is sitting here, that's cash, right? Because we spent cash to buy materials. If you're doing any manufacturing, you might have paid employees to build the inventory, but now that's sitting there until you sell it. So you want to minimize how much inventory you have sitting there, because that's cash tied up and cash not in your hands. And again, keep minimum inventory levels. We have a couple questions, I think, in the chat. I think I answered that to Steph on a prepayment. And yes, Clover, Shopify, those are all credit card processing that you can use for either brick and mortar or e-commerce. Okay, so let's talk about creating cash reserves. Okay, so that's one of the most important things that you can do, is create cash reserves. Cash reserves are that cash on hand that we were looking at in the operating cash flow cycle. That's cash reserves. I mean, some of it you're going to use on the day to day, but you want to build that. You want to build how much cash that you have. The gold standard for cash reserves is 3 to 6 months of your expenses. So think about that, because most people don't have that. Most people think, oh my God, that's ridiculous. I'm never going to have that. So that's the gold standard. What I highly recommend is that you have 1 to 3 months of expenses. A good example in hindsight is COVID. Anybody that had a service-based business, restaurant, anything like that. I mean, even a retail store, when everything shut down, you know, you you still had expenses to pay. You probably still had rent. You may still had employees if they were salaried that you were obligated to pay, maybe health insurance, utilities, anything like that. And if you're going week to week or paycheck to paycheck, so to speak, on managing your business and your cash, you're not going to make it through something like that. And so you want to have cash reserves when something changes. And it's not necessarily, this is a marker or a standard to use on how much to reserve, but there's other things that you can use those cash reserves for. And we'll talk about that in a minute. But ideally, you want to have at least 1 to 3 months of expenses sitting in the bank. And I recommend putting that into a savings account and separating that from your regular checking, or payroll accounts if you have multiple accounts. But 3 to 6 months is the gold standard. That's what you would want to aim for. Ways that you can create cash reserves. So we just talked about the operating cash flow cycle. So you want to manage that cycle so that you don't get stuck without cash when you need it. You want to create a cash forecast, which will help you understand the timing and amounts of your cash flows. You want to set a reserve goal as part of this forecasting process. And then the way to think about it is that every dollar you receive, put a piece of it into that savings account for your cash reserves. Even if it's $1, even if you get $100, even if it's $1 or $10, that you can put into that savings account and start building reserves. Another thing you can do is look at your expenses. Your expenses and your income, those are profit. We talked about the difference between profit and cash. But the idea is, if you remember from the cash flow statement, that first line was your net income and loss. And that's the net of your income and your expenses. So if you reduce expenses, you'll have more profitability. You can turn that profitability into cash. Some other things that you can do, sell any unused assets. If you have slow moving inventory, sell it at a discount to free up cash. If you have a retail store, you can, put things on clearance. I think somebody said in the chat, there was a hairdresser. If you buy product that you find you're not using, sell it. If it's stuff that you typically would use to perform the service, you can sell it to customers. If it's stuff that doesn't go well, put it on clearance. And then borrow only as an absolute last resort. If you find that you are, getting lines of credit, if you're using a lot of credit cards and it's starting to rack up, nip that in the bud as quickly as you can, because you don't want to start over borrowing. So use that as a last resort. Use it as, ways to start your business potentially. Use it as, to maybe buy equipment or vehicles, something like that, where it makes sense to get a loan. But don't use it to fund the day-to-day operations of the business. If you start getting into that, then you're starting to get into a slippery slope. Okay. Okay. So we've talked about how we can create cash reserves, and how you can effectively manage that operating cash flow cycle. So now you've got some cash reserves, you've got some excess cash. What do you do with it? Well, the first thing you want to do is pay down debt if you have it, right? As I mentioned, you want to have debt as a last resort. So as you start building up the cash reserves, what you want to do is each maybe month or quarter, I suggest quarterly, but if you have a lot of debt, you want to pay it sooner to avoid interest. Take a portion of those cash reserves, and I say 50%, but you have to gauge what makes more sense for your business and how much debt you have. Because again, you want to keep some of those cash reserves in the bank for an emergency, or if something else happens and you need it to pay for that because you don't want to borrow more. But you do want to work on paying down debt. So start putting money in your cash reserves into a separate savings account. And then once a quarter, take 50% of that and put it towards paying down that debt. And this is on top of regular monthly payments, right? So if you have a loan or even a credit card, you typically are paying that, making a payment on that every month. But so this would be on top of that. This would be an additional payment just to eliminate that debt. Okay. If you don't have debt, keep building up those cash reserves like we talked about to get to that gold standard. And use those cash reserves to reinvest in your business for capital expenditures, new products. If you've been thinking about potentially investing in looking into new products or services, that's stuff that you can use that for. Use a portion of it for tax payments. If you've got employees, that there are typically quarterly tax payments. So use that money for those quarterly tax payments. Put some of that away to pay for that so that you don't get hit out of the blue to pay for those. And if you're doing really well, use some of that to pay yourself a bonus or a draw, and reward yourself for all the cash that you've saved. So aside from using your cash reserves to pay down debt, there are other methods. Two of the most common methods of paying down debt, if you're really starting to accumulate it, there's what's called the snowball method and then the avalanche method. Both are very similar, but they prioritize the debt differently. With the snowball method, you pay down debt by prioritizing the smallest debt amounts first. So if you have a credit card, let's say that you've got a $2,000 balance on, and you've got a line of credit that you owe $10,000 on, you prioritize by paying the $2,000 off on the credit card first. You wipe that out, and then you start chipping away at the line of credit. And again, this is on top of your regular payments, right? So in a case like this, you would maybe pay the minimum on the line of credit, the minimum that you need to, and pay more on the credit card to get that paid off quicker. Then what you do is, when you've paid off that credit card, take that money that you were using to pay off the credit card every month, now apply that to the line of credit and pay off the minimum payment of the line of credit each month, plus what you were using to pay down the credit card before. So again, let's say for the credit card, you were paying $200 a month. It was a $2,000 balance. So in 10 months, you had it paid off. Now take that $200 a month and pay it towards your line of credit to get that paid off quicker. So you snowball the payments. Similarly, with the avalanche, you pay down debt by prioritizing the highest interest rate debt first. So in the same example, if your line of credit was, let's say, 15% interest rate, and your credit card was only 10%, well, then you probably, in this case, you want to pay down that line of credit first, because that's got the highest interest rate and it's costing you more in the long run. So those are two different methods that you can use to pay down debt. And ideally, what you'd want to do is take your 50% of your cash reserves and then apply that to these methods, and use one of these methods then to pay down the debt. We have a couple of questions, I think, in the chat. Let's see. How do you categorize baked goods that expire and can no longer sell? So if you have product that is obsolete, those are written off. Those should be written off, and you should, and this kind of the cash goes out when you pay for, if you have a bakery, the cash will go out when you pay for the supplies that you need to bake those baked goods, right? And the cash will go out when you pay the person baking them, maybe the people selling, whoever's involved. And then it will go into inventory. Um, what you should be doing in that case is you should have what's called an inventory reserve. And that is not a cash move. Um, an inventory reserve is something, and you should talk to your accountant about this, because there's different methods of calculating an inventory reserve. But what an inventory reserve is where when you have inventory, you expense a small piece um, of against cost of goods sold. And I don't want to get too into the weeds, but you expense a little bit, assuming that you're going to be getting rid of some inventory. So a bakery is a good example because you have a much shorter shelf life, or a restaurant. If you're selling, like we mentioned, if you're a hairdresser and you might have, shampoo and conditioner that you're selling, chances are you can mark that down and sell it that way. But that's what you typically do. You typically have expense a little bit against what's called an inventory reserve, with the understanding that at some point you're going to have to get rid of that. And that way you don't take a big hit all at once. The alternative is you can write it off and just take the hit on your income statement all at once. But again, those write-offs are non-cash expenses. So going back to managing and eliminating debt, some other things that you can do, and again, you can use these all together, or you can, combine some of these and do what makes sense for your business. But you can restructure debt. So you can work with your current creditors and lenders to renegotiate payment terms on loans. You can try to negotiate interest rates if there's any opportunity to reduce them. And again, you can extend your repayment terms. So if for some reason you have a 2-year loan, you could extend that loan. I don't suggest that, because you'll probably end up paying more interest. But if you're really in a pinch, you could, talk to them about renegotiating and extending your payment terms. Or somehow cutting your loan balances. And there are different ways to do that. But you work with your creditors and your lenders to see what your options are. The other thing you can do is you can work with a bank or a CDFI, which is a community development financial institution. And lists of those are available online. And you could get a consolidating loan or restructure your current loans through one of their initiatives. A CDFI is going to be, depending on the type of debt and credit rating you have, if you're not eligible for a bank loan, a CDFI may be able to help you out in circumstances like that. So those are a couple of options with restructuring your debt. And those can be as simple as a phone call, especially if it's a credit card or a line of credit. Those can be as simple as a phone call. Grants and investment. Look for grants always. I had a client who was just amazing at getting grants. She did all of her grant writing herself. I think she got close to, in 2023, almost $100,000 in grants that could be used. They're dwindling a little bit more for-profit businesses since COVID, but they're out there. But they do take, some work to get to. The other things you can do are look for investors that are willing to contribute cash investments. These options are a little bit trickier because any grantor or investor is going to want clean financials, right? So in order to get a grant, a lot of times they look at your financial situation. If you're looking for a partner or investor, they're going to kind of want to look at what your financials look like. So, they're going to want clean financials, and probably a lower risk business. So if you have a lot of debt, that might not be an option because, that might be too risky for somebody to invest in. But they're options. So again, start with using cash reserves and use one or all of these methods, to try and manage your debt, and your cash flow, and eliminate it. Okay. All right. So next we will look at some cash management tools. I highly, highly, highly suggest using a cash flow forecast. This is something very simple, that you can do in Excel, just like this here. All you do is start with what your income is. We'll put a pin in that for a second, on how you come up with that. But just start by listing your sources of income, listing all of your expenses. These are expenses that are typical for businesses, depending on the type of business that you have. You probably have payroll. You either take owner's draws or you have a salary for yourself that maybe is included in payroll. You may have rent, probably have a credit card, that you pay on. You probably have advertising expenses, professional fees, utilities if you are renting or own a building. You might have memberships, professional memberships, and things like that. Insurance, you might have lines of credit, maybe you have a loan, and then other expenses like incidentals, depending on the type of business. You might have travel expenses or things like that, discretionary spending on meals, things like that. So the easiest thing to do is start by listing all of your expenses, list out when they're due and how often you pay them. So if it's payroll, if it's every week, every other week, list out how often, when it's due, rent, first of the month. Start with that. Start by looking at your historicals. So in this example, the columns that are black, these are actuals. The columns that are in blue are our forecast. So start by looking at that. Start by listing out all your expenses and understand the timing. Then start filling this in week by week. And I recommend that you start by filling in, depending on the time of year, start by, looking at the actuals for the last couple of months and put it into each week. So you get a better feel of what the timing is and how much it is. And then show your net at the bottom, your net cash in and out, so that oh geez, this week, look at, I've had more cash going out than I did coming in. That way you can start to plan, right? So now that we know when our expenses are, we know the timing, we can start putting those into our forecast going out. Then I usually do the income piece last. Depending on the type of business that you have, this can change, right? And you can't always, if you have accounts receivable, you can't always predict when customers are going to pay you. But as we talked about before, you can manage that. You can stay on top of it. You can change the payment terms. So you want to, this is a little bit trickier to estimate the income. Looking at your history, is usually a good starting point. So in this case, this is just an average, right? If we look at the history, on average, we bring in $4,000 a month. In this case, in this forecast, here we see that we had much more going out than we did coming in. And so this is a case where, okay, now I know I'm going to have to borrow $1,000 from my line of credit. Again, I don't suggest it. If you can manage these cash flows, then I highly suggest doing that first. But at least now you can say, okay, I'm going to borrow it here, but maybe in this week, depending on what my cash forecast looks like going outward, maybe I can pay that back, or at least, make a payment on it regularly and, bump up the payment that I normally make, or something like that. And you want to have your cash balance at the bottom that ties to your bank account cash balance. So I highly, highly recommend doing this. It's very simple to do. Anybody can do it. It's, you know, when you first start it, it's probably going to be a little rough. You might be a little off, but you'll tweak it over time. The important thing is having that visibility and then starting to improve that forecast over time. In addition to this, just doing a cash forecast in Excel, there are some cash management softwares out there. I personally have not used them, and they're not necessary, but they are out there. I know QuickBooks has some that plug in and will highlight some things for you and give you some suggestions and stuff like that. But really doing this in Excel or even on paper, if that's the best case scenario, is a huge step. And we typically do 13 weeks. And the reason why we do 13 weeks is because that's typically a quarter. Because typically there's, 4 weeks in a month, 3 months in a quarter, and usually there's, an extra week in there. So that's typically why we do 13 weeks out, because you're forecasting essentially for that quarter out. Each week you want to look at this cash forecast. You want to update the actuals in the previous week and then tack on another week at the end. So that you want to make this part of your weekly reporting and review. Okay. And there are some other resources out there. If you are looking for like templates and things like that, or looking at softwares, just be really careful on, what you're selecting, because it is, you are putting financial data in there. So you want to make sure that whenever you download a template or whatever software that you use, that you're using it from a legitimate source. Score has some templates on their website. There's a 12-month cash flow statement. And you can change the dates on that and use it for a weekly cash forecast. And they also have a 3-year cash flow statement that can be used for a weekly or monthly cash forecast. And the SBA has some different resources as well. They have a business guide that has resources on managing your business. And then they also have some resources on funding programs on grants and SBA loans. So those are 2 sources that you can use for coming up with your cash flow statement, your cash flow forecast, and finding different resources that can be used in your business. So with that said, I want to open the floor up to questions. We do have some time, so I am happy to go back to anything, if anybody wants to review anything, or if you have any specific questions for your business.
Hey, Heather, I can go ahead and unmute microphones for our attendees. If anybody has a question, you can raise your hand and I'll go to your name in the participants list and open your mic. I will allow you to open up your microphone. So anybody that has a question or a comment, you're welcome to raise your hand and I'll get to you.
Okay, we got one in the chat.
Yeah, we have a question in the chat for you. Jessica has one there.
Yes. So, okay, membership dues in the cash flow. So if you have membership dues, and let me go back. Let me go back to the beginning. So membership dues are typically going to hit your income statement. And so those are probably going to be somewhere in here in your operating expenses. So those would come in here, those would be expensed on your income statement, and then those would roll through your cash flow statement through your net income. If you had an accounts payable, then, you know, you might have a change in your accounts payable as well, but typically, you know, memberships, in that case of a gym membership or something like that, um, you know, those are typically operating expenses and will flow through the income statement to the cash flow statement through your net income.
Yeah, Denise has a nice comment for you there, Heather.
Yes. Thank you, Denise. Appreciate it.
Anybody else? Did I see Alberto with his hand up? Oh, Eric has a question for you there.
Yes, Eric, you know, I'm always waiting for your phone call. Oh, okay. Sorry about that. That may be true. Membership dues, yes, if those are dues that you're collecting, um, then yes, those would be in revenue. Sorry, I was assuming they were expenses. I'm sorry. But yes, if those are membership dues that you're collecting, yes, those would go under revenue, but they would still flow through the net income. So, yes.
Anyone else? Oh, we do have one. Eric, I'll allow you to talk. You can go
Yeah, I
ahead.
got it. Can you hear me, Heather?
Yes, I
Yep.
can hear you.
Hey, so question, do you use QVinci as a tack on to QuickBooks?
I do not.
Okay.
Um,
Are you familiar with it?
is I'm not, but well, I shouldn't say I'm not, but I is it a cash flow management software or is it a different add-on?
It's an add-on to like QBO.
Yep,
As you're aware, my business is a franchise business. And
right.
so what they use QVinci for is to import data from all business units in the franchise system and
Yep,
then use that for stack ranking and benchmarking and stuff like that.
yep, yep.
Um,
Yeah, and we've talked about that. Um, so I'm not familiar with that specifically. However, part of my background has been I worked for a software development company.
mhm.
So one of the things that I specialize in is the data management and system side. So I do a lot of different work with a lot of different QuickBooks integrations and ERP systems in different industries and all different things for different sources of data and integrations. So so it doesn't really matter what it is per se. They all work quite similarly, especially with QuickBooks Online.
Yeah, gotcha. So you're
Mhm.
not intimately familiar with it, but by no means is it over your head. Got it.
Right. Yep.
Yep.
Absolutely.
Thanks, Heather. Great job.
Thank you.
Okay, we have a question in the chat there about using ratios.
And thank you for the positive feedback. I appreciate it. Um, yes. So one of the things I definitely recommend using ratios for businesses. I typically use the cash ratio or current ratio with clients. I typically look at debt to assets ratios and things like that. So yes, I do recommend looking at that. I always highly recommend looking at those on a monthly basis, you know, with all of your income statement, balance sheet, and cash flow statement. So yes, I do.
And you can always lean on your accountant to provide those to you also,
Right,
right?
right.
Okay, anyone else? Let's see, Eric, you still,
Oh, I'm good, but have a good night.
okay, thank you. All right. Okay, anybody else? Okay, that looks like that's it.
All right.
Heather, thank you so much. I know it's been a difficult week for you, and really appreciate your taking the time and expending the energy to go ahead and do this presentation for us. So thank you so much, and
You're
thank you all
welcome.
for being with us tonight. I want to remind everyone that you will be receiving the Zoom link to the recording of this webinar, as well as a PDF copy of the presentation slides. You also will be receiving an email from SCORE asking you to provide your evaluation comments, and we would really appreciate your going ahead and filling that out and sending it back. So thank you so much, and you have Heather's contact information in front of you, and Heather is a great source of information, and I wish you all a great evening, and all the best of health. Take care.